Welcome to TheoTrade. This is Don Kaufman. It's June 27th, 2016. You are watching the Theo Night video. First and foremost, continued volatility in the overall markets today. Really, the brunt of the hit today wasn't specific to the S&Ps, but once again, the Russell down just shy of 3% again today. Now, if you're looking at my screen, the market has literally closed about a minute ago, so S&Ps are closed. The futures are still open, and once again, in the aftermarket, some more sell-side activity again. That is one of the hallmarks and one of the telltale signs of volatility. That's trading firms kind of cleaning up their positions at the cash close over there, unloading a number of positions, obviously, to be able to mitigate a degree of risk. So what we haven't really seen yet, first of all, we didn't close in the lows today. Well, that's at least a positive sign over there, but we haven't seen one of the telltale signs of extreme volatility is a wild rally to the upside. And one of the things that I just want to cover in tonight's video before we really get things rolling, and I examine a couple of different stocks and a few sectors over here, but if you're expecting the rally back, which a lot of people do in the midst of volatility, or you're looking for like an entrance point, okay, to this marketplace, first and foremost, a strong warning to you. I'm going to go over to the spiders here to kind of elaborate a little bit about this. You know, when you get in the midst of volatility, there's a lot of kind of do's and don'ts. If there's one thing that I can really just scream at the top of my lungs, you don't go buy calls or puts that are at the money or out of the money. I can't stress this enough. If you're looking for markets to possibly rally in the next couple of days, please be aware you buy an out of the money call. If you do that, the moment the market catches wind of a possibility of a rally, even smells a rally coming, they're going to crush volatility and your hopes and dreams along with it. You got to realize volatility right now, it's elevated. Okay? You can't buy out of the money calls. It doesn't matter if the market moves up. Can't tell you over the 15 years, in my 15 years in the brokerage industry, how many times, you know, I received calls and emails in the midst of volatility. I bought a call and the market moved up and I still lost money. And that's exactly what will happen to you in this circumstance. And by the way, buying an at the money or out of the money put right now, forget about it. If you buy a put and the market goes straight down, fantastic. You're going to make some money. If the market hesitates, you're dead. Why? Volatility will get crushed. It'll suck the juice right out of the put. If the market rallies, you're dead twice over. Volatility will get crushed and the directional bias is wrong. So you got to seriously consider what types of trades you're going to use. You don't buy calls. You don't buy puts. Okay? Use spreads to mitigate your risk. For those of you, if you want to take a bit more risk in the shorter duration over here, a bit more risk in the shorter duration, you could use deep in the money options to simulate stock positions. But the issue you've got right now is you're going to have to go fairly deep. Like right now, you're going to want to go to like an 80, 85 delta. Okay, I mean, that's going to take you all the way up to like if you were buying spiders for the next 4 days, you got to go all the way down to like these 193s. Listen, volatility is all puffed up right now, and this is where clients, in my experience, this is where people get eaten alive by the markets. Okay, it's going to feel in the next couple of days like every single move that you're going to make is going to be the wrong one. Listen, that's what volatility is about. It's not about the market going up or the market going down. It's about ultimately, okay, the increased level of risk in the market, which you have to recognize provides a tremendous amount of opportunity. Speaking of opportunity, if you do follow some of the TheoTrades and some of the trades that we do in our TheoTrade tracker, we closed out of the gold position today quite profitably. So the GLD position gone, made over 55% on that one. NVIDIA I actually knocked out of the NVIDIA position today too. So it was a bearish position, NVIDIA. It wasn't really working out. We still returned 30% on that trade, but we were running out of time. So I knocked out of the NVIDIA trade. We don't have that many other positions, not any really large positions per se, other than we continue to look for more entrance points to short the bonds. Now, which leads me to the next area of kind of tonight's video here. We're in the midst of volatility. One thing, I mean, it's got me not only a little bit perplexed, but it's got me actually stepping back from my screen, and I'm like, do I really want to do this? Okay, the bonds, they're up 3 more points today. And forget for a second, this isn't just about the bonds. The bonds are a really smart marketplace. Okay, this is where, again, capital goes when it's scared. And I want to bring up like a 5-year weekly, because it's just, for the most part, this is like an awe-inspiring chart over here. And you're listening to someone that doesn't look at much charts. I'm a quant, but you got to be a little bit inspired by the fact that this is the bonds, some of the most wild moves that have really ever been recorded in bond history. This is it. I mean, we got the bonds trading from, again, 166 to 173 in 2 trading sessions. What I don't like about this is, hey, the world of bonds seems to know something that the S&Ps haven't figured out yet. What I'm saying is, you seen bonds rally like this with the S&Ps only down 30? I haven't. I've seen the S&Ps down 50, 60 points and the bonds rallying, 3, or the notes rallying, 29 ticks. The bonds have actually got me a little bit intimidated as to what the risk could be in the coming days and the coming weeks over here inside of the S&P. So again, I stress to you extreme amounts of caution given the fact the bonds have moved this far. Another area that leads me to believe that there's substantially more risk out here is the volatility index, which again, the volatility index is down today. This does not surprise me. It probably perplexes a lot of people, but it doesn't really surprise me to see the VIX down, and I'll just explain it. The VIX very often overreacts. All right? It's again, I tried to make a correlation the other day in the chat room to volatility and my wife. I think I pretty much was going to get barbecued on that one, but it overreacts. It also kind of overshoots its landing. So the VIX last Friday gets all heated up, probably overshot a little bit, so the volatility comes in just a bit. However, to throw this in a little bit of perspective and not in any way incriminate myself, if you take a look at the VIX, and again, I'm going to bring up like a 10-year monthly, you got to realize like where we're at, kind of still in like no man's land. I mean, we're down in like the mid to low 20s over here in the VIX. Volatility, again, it's just awaking. It hasn't actually felt the full brunt of, well, what's possible. And again, putting it only on like a 10-year, or for instance, a 5-year or a 3-year would do this justice to see kind of where we're at. You have to recognize that at this point, everybody, on the street sees some of the risks that are apparent. All right? Everything, and when I say apparent, I mean there's lots of transparent risks. The British exit, come on, it's over and done with. Forget about it. Seriously, forget about it at this point. The question is on the street right now is like, what other dominoes are ultimately going to fall? That's what we're all trying to figure out. This kind of selling activity over here, the bonds moving up, who is that going to damage? The dollar exploding to the upside. How much carnage is that going to create? Look down the list over here, and you start to look at individual stocks. You're like, Wells Fargo is down. Morgan Stanley's down 3%. JP Morgan down 3%. Citi down 4.5%. And it caught me off guard. Bank of America, ruh-roh. What's going on inside of there? Again, to get some sector specifics in here. Are these guys holding a ridiculous amount of risk that we don't know about yet? again, anytime volatility hits in the last 10 years, we all start pointing the finger towards the financials. Why? Because these monkeys probably are going to be what exacerbates most of the risk. The financials across Europe, whether you look at, UBS or Deutsche Bank, they're getting smoked. Here in the U.S., right here, Bank of America, that's actually a little scary. Okay, we've actually fallen from 14 to roughly 12 in 2 trading sessions. What do they got in terms of risk? I don't know, but I can tell you right now, this unto itself, just the stock movement, can cause huge issues to kind of reverberate through the marketplace in the next few days. I mean, this is what's important. If you're looking for specific setups over here, listen, volatility makes that impossible. You're going to have catalysts popping out of the woodwork. Volatility is about taking a position, whether you're long or you're short right now. I mean, you're in it, okay? It's about taking a position, holding a position, and being able to ultimately ride out the storm. Now, if you want to get short the markets, listen, today is not your day. We're down 31. I mean, that's 1.5%. Again, haircut right off the top over there. You're going to have to wait for one of these wild up days. And believe me, you will get some of those wild up days in this move. So, the volatility, you have to be extremely careful about entry and exit of positions. Use not just good judgment, but use very small allocations. If you think about volatility this way, okay, just a few weeks ago, the VIX was down at the 13, 14 level. Now the volatility has doubled. What do? Cut your position size in half. That's one of the easiest ways to think about volatility, is just that, hey, you should be trading half the size because you're getting twice the price action. And again, volatility is going to do everything possible to you to make you feel that every move you're going to make is going to be the wrong one. And again, bringing up a much longer duration chart in the S&Ps it's not inspiring. It's a little bit, again, kind of a daunting look at markets. We're, SPX 2000, still a stone's throw off the all-time highs with a whole lot of risk on the table out there. It's more risk right now, and overall sentiment is going to start to change in the markets. Remember, people are going to sell when the market rallies. Why are they going to sell? Let me ask you something. Think about your positions in your 401k. Are you comfortable right now? Of course you're not comfortable. Are you going to hold them? That's a different story. Okay, whether you're going to do something about it. But days like this, couple of down days in a row, this is just enough to make the nightly news out there and enough to cause redemptions in mutual funds. That's people wanting their capital out of mutual funds. The mutual fund comes in at the end of the day, sells the crap out of the market to give their clients back the money. Well, this is going to be making headlines in the next couple of days. And to gain some perspective, this is the last, few weeks. This is a 5-year weekly. That's 1, 2, 3, 4 ugly weeks in a row. But again, perspective. We're only down 120 points in the S&Ps. When you pull this up over the last 5 years, okay, what do you see? Nothing but downside. The downside risks right now, they're phenomenal. And that's something that I have reiterated, okay, again and again and again over time. Whether you listen to me a couple of years ago when I was on the thinkorswim platform, there's times where the risk reward isn't worth it. And right now, the risks are consistent and persistent to the downside. The upside potential I see as being limited. Think about it as you move through time. The risk reward right now is going to favor the downside. And that's the opportunities that we're going to be looking for. Hence, I still sit with my short position. I'm now short about 4,000 spider deltas. Okay, we sit, we wait, and we look for opportunistic areas. One of those could be selling options premium. I'm going to tell you right now, it's too early. Okay, hold your capital allocation. It's too early. Don't get jumpy over here. There's going to be better entry points. Thanks everybody for joining us here at TheoTrade.